Hi, ladies and gentlemen. Very happy to have with me today on the fourth episode of By the Dip, Garth Mackenzie. It's always nice having a fellow South African on the show. I've grown up watching Garth. Very happy to have him on. Very respectful of Garth. I've grown up watching him on Business Day, our major business channel in South Africa. He had his own regular slot. And I'm very interested to hear the insights that he shares with us today. I'm certainly going to pick up some pointers, and I hope you all do too. So obviously, we've also got Garth in our flagship event next week, Wednesday, Pepperstone Talks, where we'll have an evening of Garth will be one of the 10 live expert sessions presenting and how to trade the year ahead and the best strategies for 2022. Garth will be showing us some key trade setups that he likes and stuff around that. So let's get the show on the road. And we usually like to kick things off with just asking the guests a little bit about their background, how you got into the world of finance and that sort of thing, Garth. So I'll hand it over to you.
Yeah, thanks, Luke. Well, it's great to be chatting to you. Thanks very much for the opportunity. And certainly, I'm looking forward to that live Pepperstone event next week, Wednesday. That'll be fun. So, a little bit of background. I've been interested in the market since I was a teenager. I started when I was at school. My dad and I used to hand draw charts, get share prices out of the newspaper, and we started sort of trading early on. My background, I was a futures broker in South Africa for the first decade of my career. And then I left the corporate world, started to trade my own cash, and I set up Traders Corner, which is my business, which is basically helping, advising, guiding DIY traders. And I've been at that for 10, 11 years now, and still doing it. Love it. It's fun. I love the markets. It's great fun.
And you've got that high probability trading course too, don't you, Garth?
I do. That's right. Yeah. So there's a high probability trading course, which I think you actually came on it in South Africa, if I remember correctly.
I think, Luke.
And I know your dad did, because I know your dad. And so that was a live course that I did in South Africa. And since I've moved over to the UK, I've actually converted that into an online course. So it's recorded. So there's 8 hours of video material, 28 separate lectures, all with questions and answers to assess your understanding. And the nice thing about having it online is that you can watch the lectures over and over, because some of the content does go over people's heads the first time. So to have the ability to watch it second and third and fourth time really helps in people's understanding. So that course is still around, and now it's available in an online format.
Fantastic, Garth. Okay, well, given that you said you've been, in the markets for a long time, I think it was 10 or 11 years you mentioned. Sorry, that was Traders Corner, probably been a bit longer in the markets.
Yeah, longer. Yeah, I've been half my life, I guess. I'm 42 now, and I started professionally when I was 21. So, yeah.
There we go. So given that wealth of experience and time in the markets, knowing what you know now, what is sort of the one thing that you wished you could go back in time and tell mini Garth Mackenzie when you were starting out, maybe what you may do different or where you would focus on those sort of things?
Yeah, so I think if I was to go back and chat to mini Garth Mackenzie, I would say focus on process and be patient. There's a lot to be said for having a trading process, having structure, having routine in how you view the markets, how you scan for opportunities, the types of trade setups that you enact. I think for a large part of my early career, it was very much just shoot from the hip and try different things. And I think that goes for a lot of people who start out in trading. They don't have a plan. They don't have a system. They don't really know what they're doing. They just wing it. And very often with disastrous consequences. I certainly had my ups and downs as an early stage trader. I made some money and lost some, and made and lost, but I mean, my first 6 years really were net. I was a loser by quite a long way, and it took a long time to kind of learn the ropes of the market, learn how to understand the market, read the price action, etc. So I think if I had have maybe treated it a bit differently and said, treat the first 5 years as tuition. Go on courses. As I say, I've got a course that I run. I never went on any courses when I was younger, and I think if I had, I could have chopped a number of years off my early learning. So go on courses, read books. There's some phenomenal books available on trading. podcasts. There's so much information as well on YouTube and these types of things. I mean, there's a hell of a lot more resources available to a youngster now than what there was when I started out in my career. So those are the kind of things that I would advise a youngster to do. But yeah, be patient and develop a process, figure it out, and just be patient. Realize that, Rome wasn't built in a day, and it takes time to become proficient as a trader. It doesn't happen overnight. And also understand the power of compounding. If you can just trade and make a little bit, but you can slowly but surely compound your returns year on year, you can actually make an enormous amount of money over time. The trouble is a lot of us end up learning that when it's, much later on in our career. But if you're a youngster and you can grasp that concept of compounding and being patient and allowing a process to play itself out, that can be very, very powerful over time.
So allowing that capital base to grow over the years and not trying to take on those really risky trades and blowing up your whole account is very important.
Absolutely. It's very important, and I see it a lot of retail clients. They overgear themselves, too much leverage. And then, it can either go spectacularly right or it goes spectacularly wrong. And the trouble is that it is going to go spectacularly wrong at some point if you trade like that. So you might be, a hero for a while, but the trouble is that often then also breeds a sense of overconfidence.
Invincibility.
Exactly, invincibility. And then when it eventually does go wrong, it can go spectacularly wrong. So managing your risk is very, very important in this business, knowing how much you can lose on an individual trade and keeping those losses small. It's important for both your financial capital, obviously, but also for your mental capital. You want to try and stay confident. And if you take big losses, that can really hurt your confidence. You don't want to get into that place.
True. Completely agree, Garth. Well, that sort of dovetails into our next question, which you did allude to a lot in the previous question, which was, what are some of the biggest tips that you could give to new traders as well as major pitfalls to avoid in their trading journey?
Yeah. So I think kind of what I've said already on the previous answer, same things really. Treat the first 5 years as tuition. Know that you're going to pay school fees. In this game, you can't go to university and get a degree in trading. So you just kind of learn it on the job, which is a strange, it's like an apprenticeship in a way. But, if you think about other professions, you study to be an architect or a lawyer or a doctor or a chartered accountant. You go to university for a number of years. You learn, you come out at the end of it with a piece of paper and a whole lot of knowledge in your head and a professional qualification that you can then use. Trading is not like that, but the reality is that there's no shortcuts either. You have to do the time and just expect that it's going to take you time. If it takes you 5 years to become an architect or 7 years to become a doctor or whatever, don't think it's going to be much easier to become a trader. So understand that you need to pay your school fees in the beginning and treat your first years as tuition. And start small. I think if you accept that you're going to pay school fees, try not make them expensive school fees. Try and, so start with a small trading account, learn the ropes with a small trading account. Don't blow up a big trading account. Just start small, learn. Manage your risks very carefully. And like I said, take courses, read books. There's so many good trading books out there. Watch some videos, YouTube, podcasts, etc. Plenty of resources available now to the start-out trader.
And I suppose also, practicing your strategy potentially with demo accounts now instead of using your real money straight away. That might also be another handy thing to do. What do you think about that, Garth?
I think so. Yeah, look, there's benefit in using demo accounts from the perspective of learning the very basics about how you buy, how you sell, how you set your position size and where you put a stop loss, and just learning the ropes of the actual system. I think there's method in that, but also the one thing that a demo account will never give you is that emotional, euphoria and disappointment that you get
when
in the market.
Real money, yeah.
Yeah, and when it's your own real money on the line, then you feel it. You really feel it when it's your own real money. Whereas if it's just play money in a demo account, it doesn't matter really. If you lose it, it doesn't matter. It doesn't hurt you. So to just understand that, yes, demo accounts are cool to learn the system and, just mechanically understand how you place a trade. But in order to feel the emotions of trading, you need to do that with real money. But as I say, don't start with big money when you're learning. Just start with small money, but just enough that you feel the pain of loss and the joy of success.
Yeah, true. Garth, okay, moving into 2022, I think, the market's sort of beta sensitivity is going to remain high with regards to key macroeconomic data releases, I think causing swings in either direction, depending on if it's a beat or a miss. So how do you as a trader trade around these more volatile events and also the high volatility that we're expecting throughout this year?
Yeah, so I think that's right. I agree with you. I think we're going to see increased volatility this year. Certainly the backdrop has changed. It is changing. We've had all these tailwinds in the form of easy monetary policy, low interest rates, etc. All of that is now coming to an end. Tapering is happening. Interest rates are likely to rise this year in the US. The Fed is going to shrink its balance sheet. So all of that is what was a tailwind effectively is now stopping and is actually going to become a headwind later this year. So that's a very different backdrop for the market environment. And I think absolutely it's likely to introduce all sorts of volatility. We've already begun to see a bit of volatility now in the early part of this year, but I think that's probably just the beginning. I wouldn't be surprised if there's a lot more volatility still to come. So how to deal with it? Look, I trade to a playbook, and I've effectively created my own playbook, which is a bunch of technical setups that I identify in the market. And when I see those setups, I trade them. So you get different setups that fit different market environments because nothing works all the time. So I have effectively 3 buckets, if you will, in terms of the types of market setups that I'm looking for. So a bullish rising trend environment is one. Bearish declining trend environment is another one. And then the choppy range trading type of environment is another one. So they're all in your silos. And within each of those silos, I've then got technical analysis setups that apply to that type of market environment. So, if I take a view that we're maybe moving into either the choppy sideways, range bound, noisy kind of an environment, then I've got technical setups that I'll look at to trade that. And also there's a fairly good probability, I think, that we could be moving into downtrending environment in certain areas of the market. So I'd then apply the playbook setups to those bearish setups. But do also keep in mind, the market's made up of various different parts. So there will be some areas that are bullish. We're seeing right now, for example, growth stocks are under pressure, and your typically bullish trading setups are not working in that part of the market anymore. So you need to adapt and apply perhaps a bearish trading strategy to that area. But on the other hand, you've also got defensives and value stocks that are really looking good. I mean, some of the energy stocks, the oil stocks, those types, some of the financials are looking pretty strong at the moment. So you can still apply your bullish technical environment setups to those areas of the market. So I guess it's a case of the way I trade it is I'll apply my playbook to the market, see what setups are presenting, and then just trade them in accordance with how my rules dictate I should trade them.
Okay, Garth, so let's say your playbook, you identified a bullish trend in cable, so pound dollar, and you were long, you'd taken a long position and you were still holding that long position, and there was a Bank of England meeting coming up. Would you close out that position or would you hold it through that event risk? That's sort of what I'd like to know.
Yeah. So look, there's around those kind of events, obviously you do get a lot of volatility, and often it's actually best to just be out of the market because it can become a bit too random or a bit of a lottery. You get a market moving event or a statement like that. It can either move the market very nicely in your favor, or it can move aggressively against you. And you don't always know which way it's going to go. And the other thing is the news might come out the way that you think it's going to come out, and the market may not react the way that you expect it's going to react. So for that reason, I do tend to try and rather shy away when there's an announcement due. Often what I might do is try and trade an overreaction to an announcement, because then what you've got is you've got the news, you've seen the market's reaction, but you know that often these things do tend to push too far one direction or the other. Or alternatively, the news might validate a technical setup, push it through a level, and then you follow that trade. And so it depends on each individual situation. But when it comes to data, you do have to be careful, because it does move any product really, be it an equity, be it the Forex market, as you've said. You can get big movements after a data point, and they're not always favorable. So for that reason, I tend to mainly be out of the market ahead of a big data point. Yeah.
Okay, very interesting insights there, Garth. All right, well, on to the next question. So one of the hardest things for a trader, I've personally struggled with this in my sort of trading experience, is knowing sort of when to exit a trade that's become profitable. So in your sort of setups, do you have a predetermined targets? And if so, what are they based on? I know you like your cricket analogies with getting runs on the board. Do you think using, and sort of further on that point, do you think using trailing stops or scaling out of positions, so, not closing only a partial position, not closing the full position, could be beneficial? So we've got, how do you determine your targets? And we've got trailing stops and scaling out of positions.
Yeah. So how do I determine my targets? So each technical setup in my playbook has a target. So there's a measurement from, and these are fairly bog standard technical setups that I'm looking at: triangle patterns, flag patterns, head and shoulders or inverse head and shoulders, rising wedges and falling wedges. All of these are fairly common technical patterns. So you can often project a target based off of those types of patterns. So I'll invariably have a target in mind, but often what happens is you get to the target and the market might actually run beyond that point. And that's where you come to the whole point of, or the concept of, running your profits. Do you snatch at the profit once it's there and you've got it, or do you hang on and try and see if you can extract more? So I'm always of the view that I often will scale in and out of a position. So I might not go all in at once. I might sort of build a position with a couple of different entry points. But then at the same time, I'll exit it in the same way. So I'll invariably, when it gets to my initial target, I will take some of the trade off, possibly as much as half of the trade. I'll just take it off, because I think it's important to pay yourself for a good trade, pay yourself for a good entry and a trade well executed. But it is always nice to run a profit if there's more to be had. So when that happens, then I'll bank half a profit, and then I'll look to try and run a trailing stop loss on the remaining half of the position. So if I look at 4-hour charts, 1-hour charts quite a lot in terms of the shorter time frame. But if I'm trading a stock, then I might I will use the daily charts often, and I'll use a 15-day exponential moving average on a daily chart of a stock. And what I've found in the past is, if a stock is really going to trend well, it tends to stay on the right side of that 15-day exponential moving average. So yes, you get some noise up and down and what have you, but in a very strong trend, if you're going to have a look, you'll find that a share's price in a strong rising trend or downtrend, but let's just use a rising trend as an example. You'll find that a share's price does tend to stay above that 15-day exponential moving average in a strongly rising trend. And so I'll use that as a trailing stop loss. If it's effectively a close below a 15-day exponential moving average, then is a trailing stop. Another way you can also apply a trailing stop with the daily charts is I'll look at a previous daily low. So if the price closes below the prior day's low, then I'll exit. That'll be a trailing stop in that case. So by doing that, you're allowing yourself to bank some of the profit at an initial target, and then you're allowing yourself to run some of the trade further beyond that. And also then just an add-on to that is, once the trade is moving in the right direction, move the stop loss up to your entry point. So there's effectively no risk on the trade. And then often what I'll do is, once I've got to that first profit-taking point, bank half the profit and then move the remaining trailing stop loss up to that point. And then you're effectively giving yourself only upside with limited downside. So that's the issue around trailing stops. So what was the second question?
So you answered that really well. It was scaling out positions, trailing stops, which you've mentioned, and then it was predetermined targets. So the one thing I just wanted to, after you've answered now, is, so you said you use a daily chart mostly for equities, but maybe for like Forex or other instruments, you'll use a 4-hour, 1-hour chart. So do you use the similar sort of indicators, a previous candles low or two previous candles low, or a moving average or something? What do you do on those shorter time frames, Garth?
Yeah, on the shorter time frames, also I'll look at a technical level. So it may be below a couple of candle lows or candle highs if I'm short, depending which way I'm positioned. But I also, on Forex, I tend to drill down my process, and we'll talk about it just now when I show you some charts. But start with the bigger picture. So I'll look at the daily charts, then zoom it down, look at the 4-hour charts, then look at the 1-hour chart. And I generally do my execution off a 1-hour chart. That's just the type of trader I am. I mean, I know some traders will go into a shorter time frame. They'll look at 1-minute charts or 5-minute charts, and that's fine. I mean, there's different ways to do this. You've got to find a style that fits your personality. Personally, my style is I'm not so short term in nature, so I don't usually go below a 1-hour chart in terms of the timeframes that I'm looking at. So then I will base my trade signals off of that 1-hour chart. So, look, if a 1 hour is breaking above a certain level, I'll buy, but then the stop loss needs to be below a couple of previous hourly candle lows, as an example. Okay. I also use the moving averages as well on the lower time frames as well. So something I've been using mostly lately on an hourly graph is the 15-period exponential moving average and the 30-period exponential moving average. Okay. And those two I kind of use as a guide. So the 15-period exponential moving average I use as effectively like an entry signal. I want to be on the right side of that 15-period exponential moving average. And what you'll find is that the 15 and the 30 tend to move in the same direction for the most part. But when they cross over, that is usually the signal that the move is done and it's time to get out. Why I use the two of them and not just the one moving average is that by using a 15-period moving average and the 30, you'll find that sometimes there's noise along the way that'll cut through the 15 EMA, but it's not enough noise to then also break through the 30 EMA or to cause the two to cross over. So for that reason, I find it just filters out the noise a little bit by having the two moving averages side by side. And those are good for a number of reasons. I mean, they help me with my entries. They also help me to run a profit. They also help me to with an exit as well, because you can see quite clearly when a move is finished, when those moving averages begin to converge and then start to cross over each other.
Okay, very interesting, Garth. Yeah, I think that was a very comprehensive answer. So the next question is sort of slightly similar, but it's what are your thoughts around adding to a winning trade? If you believe in it, what do you look for to give you more conviction about this?
Yeah, so this is it's a tricky thing I find, adding to trades. What I'll say is that in my experience, adding to winners they always say, you must add to your winners and cut your losers quickly, which is absolutely correct. But adding to winners is a tricky thing to get right, because I think it depends on how long you're planning to hold a trade for and what your time frame is. So where I find adding to winners works quite nicely is on an equity trade, but it's a trade where I'm maybe taking a 3 or 5 or 6 months view, okay, and I've got a much higher target, and I'm willing to ride out the noise. But as I see shorter term technical setups emerge, I can then add to that trade and almost treat each separate addition to the trade as an independent trade on its own. So yes, it's the same stock, but I'm adding in incremental amounts on the way up. But then each incremental little addition to that trade becomes a separate trade on its own. It's got its own stop loss, its own risk metrics, etc. And they talk about pyramiding. So pyramiding also by the name of the pyramid. You think about a pyramid, it sort of starts with a big thick base at the bottom, and then as it gets higher up, it gets to an apex. So effectively what you're doing as you pyramid is you start with a sort of a larger position, and then you add in smaller increments as that trade moves in your direction. all the time managing your risk very carefully and ratcheting your stop loss up on the overall position so that your risk is contained to a certain percentage of capital. I said that I find it's easier to do on medium to longer term positions. And let's just bring it back to shorter term positions. So where I find it very hard is on a short term trade where I've maybe got a view for maybe a couple of days on a trade. You go in, it starts to move in your direction, then you add to it. But now what you've effectively done is you've made your position bigger, but you've made your average entry price worse.
So your risk-reward ratio changes a bit then.
So your risk-reward ratio changes, and then also you now become more susceptible to that volatility and noise. So what I've found happens so often is you'll go and you get a great entry on your first leg of the trade. Then it starts to move in your direction and you think, cool, I'm on the right side of this. I'm going to add to it. Now you've made the position bigger and you've probably added to it at a slightly short-term sort of stretched level. Then the retracement comes. And now you're suddenly back at break even, or you may be even losing a bit of money on the overall position. Now you're getting nervous. Do I want to hold this? Doesn't feel right, etc. And then you might be inclined to exit the trade or even get stopped out. So from that perspective, what I tend to do on the shorter time frames is actually I'll just rather go in. I'll say to myself, how much do I want to risk? What's the size of the trade that I'm willing to put on? And then put the full trade on with the initial entry. And let it then do its thing. And I find that works rather than trying to add, and then you end up, as I say, with a bigger position at a worse entry price, and it becomes messy. The other thing, just to this point, Luke, is something I've experienced a lot over the years. Is people think you can't make money out of trading small positions, but quite often I find the contrary. You actually can do well out of a small position, because when your position is small, it doesn't make you don't have as much emotional attachment, or you don't get as emotional around a smaller position as you do around a bigger position. And that the lack of that emotion also then means that you've actually got the stomach to run the position more. So I've often found that with a small trade that you actually are willing to run to a higher target, you can actually often do pretty well, as opposed to a big position that's then you become uncomfortable when it starts to wobble around a bit, and maybe you exit too quickly, and you often end up actually not making as much money, or even getting out even or with a small loss. Whereas if you had have just held a small position, you could actually have just weathered the noise, weathered the ups and downs, and got to the target and made a decent profit at the end of the day. So I've found myself doing that quite a lot, where I'll have a smallish position on and then think, all right, I should actually add to this. But then I go back to this principle in my mind and I think, but hang on a second. If you add to it, you're making the position bigger, and you're going to just worsen your average entry price, and you're going to be more sort of nervous about the position because it's bigger. Rather just stick with the little position and run it, let it get to its target. And funnily enough, I find more often than not actually make more money that way than trying to get too clever on bigger positions.
I guess you could bring that back to your cricketing analogies, Garth. Instead of trying to go for those sexy sixes, taking, massive swings, you could rather get the threes, the twos, the fours on the board and build that up gradually, instead of trying to jump with those massive, large positions. Anyway, moving on to our next question, because we've got a whole load to get through here. Garth, one of the most important things and one of the first things we taught as traders to manage our risk, it's what keeps us in the game. So how do you approach position sizing? Additionally, do you use a fixed risk reward ratio for all your trades, or is it more discretionary and dynamic based on the instrument or what's going on in the market, that sort of thing?
Yeah. So first up is the risk. I generally don't like to risk more than 1% of my trading capital on any one trade. So, and that's come down over the years. I mean, the old rule is, 2%, don't risk more than 2% of your capital. That's fine. Maybe it's just because I'm getting older and don't have the stomach for it anymore, but it's also because I'm trading with bigger capital now as well. So I find that risking 1% is fine for me. In fact, sometimes I don't even risk as much as that. I might only risk between 0.5% and 1%. And it doesn't sound like a lot. And just for the viewers who maybe not familiar with exactly what I mean by that, I'm not saying that the size of my position is 1% of my capital. What I'm saying is that the risk, the amount of money that I'm willing to lose is 1% of my capital. So let's just take an example. Say we've got £100,000 in a trading account. 1% of that is £1,000. So I'm not willing to lose more than £1,000 on an individual trade. If that trade goes wrong and it gets stopped out, the maximum I want to lose is £1,000. And then you work that backwards to get to your position size, such that you never lose more than that 1% of capital. Now, in terms of risk to reward, it's not a fixed risk reward ratio for me. I mean, I like trades where I can get, at least a 2-to-1 risk reward ratio, but preferably 3-to-1 or more. Those don't often, sometimes you have to be very patient to get a 3-to-1 risk reward payout, but they do come around. And I find often actually, if that word patience is important. If you are patient and you wait for the right setups, they do come around. The trouble is a lot of the time we're impatient and we want things to happen. We want to be trading all the time. We feel like we need to be involved. Patience is important. Sit back, wait for the right opportunities to come. And when they present themselves, then trade them. But also just another point around this risk issue is you can also undertrade as well. Some people are too conservative. And occasionally I found myself falling into that trap as well. Where I'll say, well, I'm only going to risk 0.5% or 0.4%. And the thing is that it's fine, but you're not also going to move the needle much when you are right. If your risk is too small. So you almost need to find a risk number that is, big enough that it counts when you get your trades right, but small enough that it's not going to hurt you too badly when you're wrong. And I think to this extent, there's something I read very recently, which is so interesting. And it's just around the concept of trading to win versus trading not to lose. And they're very different. Trading not to lose it's not the way to play any sport or any game. Not to lose. You want to play to win, right? And it's the same in trading. So just be careful of maybe setting your risk too low, because then you start falling into the trap of trading not to lose, and that you're not going to really get ahead like that. You need a fine balance of risk management, making sure that the losses won't hurt you too badly when they come around, and they will come around. But then also knowing that what you can potentially make on a trade is significantly more, and it actually does move the needle. And lastly, on this point is that small risks that might not sound very sexy, but doing this over and over and over, and stringing a whole bunch of winning trades together, smallish winning trades. When I say small, like, maybe you're making 2 or 3 or 4% of capital on an individual trade, but those add up, and you'd be amazed over the course of a year if you can, string a bunch of those types of winners together, 3 or 4% at a time, and you're keeping your losses to less than 1% when you're wrong. You actually can do very, very well over the course of a year. And I think it's important to remember that, and just know that it's kind of like that cricket analogy again. You don't have to hit a 6 off every ball to put runs on the board. You can run singles or 2s or 4s, whatever, and you can actually build up a nice score doing that. And I think that's important for traders to remember, is that we're all here ultimately for a long time, maybe in a good time, but not, this is not, if we have to go back to cricket, this is not IPL cricket. This is test cricket. This is test cricket. We want to try and keep our wicket. We want to stay at the crease. We want to build the score gradually. We want to be there for a long time.
Fair enough, Garth. Very, very insightful. Very quickly, how would you describe your trading styles? From what I've gathered, it's mostly trend-based, momentum trend.
Yeah, it's sort of
maybe a bit of mean reversion. I don't know. Yeah.
Not always. Sometimes I have got a mean reversion strategy that I look at.
I was referring to what you said earlier about sometimes when you get that overreaction to news flow and you think it's moved a bit too far, it's like run.
Yeah, so that would fall into a mean reversion camp. And I suspect that we're going to get more of maybe those types of opportunities in the year ahead now, where maybe things overshoot too far one direction or the other, and maybe there's a bit of mean reversion to be done there. But usually my trading strategy is around trends, and I'm looking at, uptrends, downtrends, sideways trends, trying to capitalize on the direction of flow overall. But I mean, if you had to say in a word, I mean, I'm a swing trader with using trend lines and using technical analysis.
Okay, perfect. Garth, obviously patterns, there's a lot of things, you can either go one of two ways. You can trade the breakout of the pattern, or you can try and anticipate the move. So that's what I wanted to know is, do you like to trade the move early, or do you prefer to wait for further confirmation in the form of a breakout or another signal?
Yeah, so a bit of both. If I am going to try and preempt a break, which is often dangerous, and in fact, probably should always wait for the confirmation just to be safer. But the thing is, it is sometimes enticing to try and preempt a break. If you've got a strong eye for the charts and you've got a bit of intuition, you can sometimes get a strong sense that a stock is about to break out or break down or whatever. So you can maybe start entering a position in anticipation of a break, but keep it small and have a fairly tight stop loss, because if a break doesn't happen or it fails, then that often can snap quite viciously in the other direction. So I might go in with a small part of a position. Like if I've got a view to enter a trade in 3 different tranches, what I might do is put on one tranche of the trade preempting the breakout. And if it then does break out, I'll add the other 2 tranches to the trade. But if it doesn't, then I'll exit. And at least I'm wrong on only a third of my initial position size anyway. So the losses are kept pretty small that way. Preempting the breaks does improve your risk to reward ratio when you get it right, but it also increases the risk because you're effectively preempting something which hasn't happened. And purists will say you shouldn't predict, you should react to what the market is doing, which is fair enough. But I kind of think that you can adopt a little bit of a hybrid approach as long as you're doing it within your risk parameters and your position sizing is carefully calculated and everything else. There probably is some space for a little bit of a hybrid approach to those 2 ways of going about it, preempting the break or following through once a break has occurred.
Okay, great. Garth, we're almost on to the most exciting part of the show, where you're going to share your chart with us and run through putting the mind obviously into the screen. But the final question before we get there is, do you see any value in pivot points, or do you prefer to draw on your own discretionary support and resistance levels on the chart?
Yeah, I personally prefer drawing them in myself. When you see a series of tops that was broken out, that becomes support on a pullback, etc. So I do prefer to draw in my own trend lines and my own supports. Having said that, I don't dismiss pivot points at all. My partner in my Traders Corner business uses them a lot and quite successfully. So I think there is definitely merit to looking at pivot points as potential support or resistance levels, because they do seem to work more often than not. So absolutely, but for me personally, I think this is just a personal preference. I prefer to just draw in my own support and resistance lines.
Perfect. All right, Garth. Well, we're on to the most exciting part of the show, and you're going to share with us a Euro US dollar chart, and you're going to basically just talk us through how you think about that trade setup. So
yes, right.
The floor is yours.
Right. So I assume you can see my screen now. Hey,
yeah, perfectly. Yeah.
Okay. So so this is Euro dollar. I just thought it's interesting at the moment. It's something that I've certainly got my eye on right now. The dollar has been pretty strong over the last number of months. but it does look as if that it may be starting to turn. So when this trades lower, obviously this is the euro versus the dollar. So when it's trading lower like that, that implies that the euro is weakening and the dollar is strengthening. The backdrop for the dollar looks like it could be starting to shift now. We've got the US talking about, not talking about it, but they're going to actually be doing a tapering of their stimulus measures. And then interest rate hikes expected to come later in the year. But effectively, this injection of stimulus into the US economy is being pulled back. And it does appear as if there's a little bit of sort of potential for flow out of the US and certainly out of their bond market, possibly out of their equity market as well. So that kind of a backdrop for the strong dollar does look as if it may be under a little bit of threat now. So what we're seeing here now is just purely technicals. This is a daily chart of the euro dollar. There's that strengthening trend for the dollar, the weakening trend for the euro. And it's begun to try and break that downtrend line now. But what got me more interested than that is actually the fact that it's managed to take out these recent highs here, which have been intact throughout December and into early January. So what I want to do is just go zoom in. This is still the daily chart now. But what I'm specifically interested in here is the fact that this price has broken through there. That's about 11350 is the level. Call it 11350, 11370, thereabouts. Also notice I talked about the 15-day exponential moving average, and there you have it. That blue line is the 15-day exponential moving average, and now the price is above that, and that moving average is beginning to point upwards. So that's telling you now that the momentum is actually moving higher. You've also got a crossover of the 15 EMA and the 50-day moving average, which in itself doesn't mean a huge amount to me as a buy or sell signal, but what it does tell me is that the momentum is actually now shifting. Because when your 15 EMA is below the 50-day moving average like that, that is generally a bearish trending environment. But when they flip over like they've just done, where you've got your 15 EMA above the 50-day moving average, that is often associated then with a bullish environment. So the fact that it's made that break above the 11350 area and above those moving averages, and that the 15 EMA is now pointing upwards, gets me interested. And what I would expect now is this area where the breakout occurred should now become support. So it was resistance, it pushed up, couldn't get through. Finally, earlier this week or late last week, it managed to break out through that resistance. And now that should be support into any pullback. Okay. So around that 11350, 11370 sort of area is where I would expect to see some support coming in for the euro. So then I'd take it down another time frame and have a look at the 4-hour chart here. So obviously far more candlestick patterns in this because it's no longer a daily chart. It's now a 4-hour chart, but the data is the same. It's just more detailed. And there you can see that significant zone around 11350, 11370, somewhere there. The breakout occurred. And now you've got this pullback, and that's looking like a really nice, healthy falling wedge pattern that we're seeing over there. Now, falling wedge typically happens in a rising trend, and they usually will break to the upside. So what I'll be looking out for here is the potential for it to come back into this area of support and then eventually to actually break out the upper end of that falling wedge pattern. And that would give me the signal to then go long the euro, long euro dollar. Okay. And then in terms of a stop, well, it would be somewhere down here, basically below the lowest point in that falling wedge before a break higher occurred. So it would probably be down here somewhere underneath 11350, thereabouts. So it's out of the way, but close enough that I'm not going to lose too much money if I'm wrong. So that's the 4-hour chart. And then lastly, this is the 1-hour chart. So this is where I'd actually do my actual execution. And as I said, the falling wedge is evident over there. The support zone is evident there. So how would I trade this? Well, first I probably look for evidence of clear candlestick reversals down here in this support zone. That'll be my first clue. But then
so
ultimately,
touch the support line, stick there a little bit, and then reverse higher before you try and preempt the position. Okay.
That's it. And remember, these things there's often noise around these areas. So you've got to be aware of that noise and do not get spat out or thrown off by the noise. So maybe it comes into that area, bumbles around there a little bit. But then what also will happen, I mean, when I say will, I don't know, but what I suspect should happen or will likely happen is ultimately then if it holds that support, it'll begin to turn up. And once your price breaks above that downtrend, which is the upper end of that falling wedge structure, and also once the price moves above these moving averages, so that's here I've got a 15 exponential moving average and a 30 exponential moving average. And what I want to see is for those two to both cross over and for the price action itself to get above both of the moving averages, because that then gives me confirmation that my view is right and that other buyers are coming in and they're actually pushing the euro higher. Until that point, I'm guessing. I don't know. I mean, it might not hold that support. It might just carry on heading down. And if that's the case, well, then I don't want to be buying. So it's for that reason that I'll be patient, wait for the price to break up above the top of the rising wedge pattern. And also what I want to see those moving averages, flatten out and then cross over and start to turn upwards, because that'll then give me added confirmation. And I suppose if we have to look at a sort of a similar setup, maybe it's like over there, you can see that moving averages began to turn up, the price moved higher. And often what you'll see in a strong move is that the moving averages will stay apart. Your 15 EMA will stay above the 30 EMA in a nice, strong trending move. So,
and the stochastic, Garth, is that going to be giving you any information there? It's near oversold territory there.
It is nearly oversold now, yeah. That not necessarily in its own right, but where I do sometimes look at the stochastic and find it useful is when it's showing up divergences. So if we were, for example, to get a setup here where the euro dollar price starts to make sort of lower lows, but you're starting to see evidence of a higher low forming on the stochastic, then that'll be positive divergence. I mean, you can see it. There was actually an example of it back there where you've got positive divergence. So your stochastic is making a higher low, but your price made a lower low. And that divergence very often indicates that the trend that you're in is slowing down and that it's about to turn. So that's where I would apply the stochastic oscillator to help me to, if it does set up positive reverse divergence, that would be an added confirmation that what I'm looking at is correct.
And your target for this sort of trade, Garth, where would you be identifying potential places where you could exit the trade?
So this one with a falling wedge pattern like this, generally you look for it to go back and test the top of the wedge. Okay. So in this case, that's at about 114.80, somewhere there. But I must say, given that broader structure that I spoke about on the daily chart, I think that there's potential here for not only a short-term trade where you would look to trade off this 1 hour chart and look for maybe 100 basis points move, or 100 points move. But I think on the more medium-term charts, there's probably scope for a lot more if we have indeed seen the low in that euro dollar pair.
It would be so strange, though, with the ECB staying more dovish than the Fed, who's just starting their policy of normalization. But I suppose you've got to read the tape, eh? You can only trust the fundamentals for so long. If the price is telling you something else, you've got to read it. Garth, just quickly, something else I picked up was on the daily chart, you've got the RSI and the stochastic. Now, some say you should try and pick one momentum indicator over the other. So is there a reason why you particularly have both? Could you just maybe shed some light into that for the viewers?
Yeah, so I think it's personal preference, really. I use both, but if you forced me, I'd probably take the stochastic over the RSI. But I do use both on my charts, and I think it's just a template that I've had for a long time, and I've kind of never really changed it. Another question I get asked about this similar sort of question is, why don't I look at a MACD? The moving average convergence, convergence divergence, MACD.
Tongue twister.
It is a bit, yeah. And again, I mean, I've got nothing against that as an indicator. It often will yield the same kind of reads as I'll get on a stochastic. So I don't really see the need to have that as well, but I've got nothing against it. I think the key thing here when it comes to technical indicators is, first of all, the most important thing is price. Price is king. That is critical. So what is the price doing? And that's what you really, really want to focus on. But then secondary to that is all of your other indicators. So your momentum indicators like your stochastics or an RSI or a MACD. Those then come in to sort of provide support, if you will, to a trade, to add confirmation to a trade. But if you said to me, you've got a trade and you're not allowed to have, you're only allowed to have one indicator on your charts, only one. I would say, well, just give me a price chart and let me use trend lines. Mm. That's all. The rest of it, it's nice to have, and it is helpful, but actually the price action is really what you want to be reading in a chart and trading off the price and respect the price.
Garth, I've got two final questions for you just now that you pulled your charts up. I'm really interested in this chat we're having. First one, I noticed your stochastic settings changed to a lower setting or faster setting, you could maybe call it, from your daily. Is that just to give you a more earlier signal on the shorter time frames? Okay.
Yes, that's it. Yeah. I said it's slightly faster on the 1 hour chart versus on the daily charts. Yeah.
Okay, perfect. And then the final question, it's sort of got two parts, is would you maybe try and use, what do you think about Fibonacci levels and Bollinger Bands? Like I could roughly, now I'm looking at your chart, maybe you could draw in a swing low and a swing high here potentially. Yeah, what do you think about Fibonacci and Bollinger Bands?
Yeah, so Fibonacci is interesting. I do look for, the one I look at most is actually a 61.8% retracement. So if we've got a rising trend, I'll look for the pullback into the 61.8% retracement. And that's sort of a zone where I would think some support should emerge. But again, this is one of those secondary indicators, which is, it's useful, it's nice to have, but I don't always use it. It's something like this setup that we've got here, and I can't unfortunately pull a Fibonacci on because this is just a PowerPoint slide that I screenshotted for you. But I know just from sort of eyeballing it, from these recent lows to that high, if I was to bring a Fibonacci retracement, it would come down here somewhere around about where that support zone is anyway. So I would just look at it and say, okay, that's interesting. I mean, clearly there's lateral support there anyway, but it also just so happens that is also a 61.8% retracement zone. So that kind of adds another tick to the box, if you want, in terms of saying, well, this is a fairly strong area of support. That's where I would expect the price to turn and where I would expect buyers to come in. But I won't ever use a thing like Fibonacci's in isolation. It's always got to be complementary to other setups. And like I say, the price is really the most important part of the chart for me, far more important than any of these other things.
And Bollinger Bands, Garth, do you see much value in that? So
I find Bollinger Bands are useful in a sideways market. Okay. I find they're not much use in a trending market. But in a choppy sideways kind of a market, I find that the Bollinger Bands actually are quite useful. What I've usually found, if you are in a sideways market, what you want is just make sure you get a clear reversal off either a lower or upper Bollinger Band before you enact a trade, and then use a stop loss outside of that reversal, be it a reversal at a high or a reversal at a low. But I mean, that's where it works, is in a choppy market. My first taste of Bollinger Bands when I was much younger was in a trending, and in fact, unfortunately, a downtrending market. It was during the .com bubble burst in the year 2000. And there was a company called Dimension Data. You might remember it from South Africa. It was actually listed on the FTSE as well. And it was coming down and it got to the bottom Bollinger Band. And I thought, okay, well, then this is the time you buy. When it hits the bottom Bollinger, you must buy. And it just carried on hugging that bottom Bollinger Band all the way down. And it's kind of stuck to it as the trend declined. So that was a baptism of fire for me in terms of Bollinger Bands. And I'll never forget that. But it also taught me then that Bollinger Bands don't really work that nicely in a trending market, but they do work quite nicely in a choppy market.
Yeah, you've got to be, it's stories like that. It reminds me, I had a position in EOH many moons ago back in South Africa, and I was long on a breakout sort of sideways rectangular pattern. and that news about fraud came out, and it slipped right through my stop loss. I think I had about 3 Rand per share slippage. So baptism of fire for me too in that. But Garth, I don't want to take up any more of your time. Thank you so much for coming on today's show. I know I personally found it very valuable, and I'm sure our audience will too. And I'm looking forward to you sharing more of your insights in next week's Pepperstone Talks event, which clients can sign up to on our main homepage on our website. Thanks very much, Garth. I appreciate you coming on.
Thanks, Luke. Thanks for the opportunity, and I'm looking forward to seeing you next week. Yeah, cheers.
Perfect. Cheers, Garth.